Welcome everybody. I'm John Zink with the PHCC Educational Foundation. We're very happy to have you all here today, and we are proud to present today's webinar on understanding overhead and pricing. How to calculate your direct cost overhead and determine your proper selling price. My name is John Zink. I'm Vice President of Education and Programs for the PHCC Educational Foundation. I've been here since '97, and for most of that time I've been working on the Foundation's business management programs. So anytime you need to get in touch with somebody about this software program, about the seminar series, our project management course, the HR personnel e-bulletin that we send out each month, the Contractor Resource Center, the Foundation website, the Focus newsletter, the scholarship program, any of those things, I'm your contact. I also work with a great bunch of folks who help me do some of the fundraising work for the Foundation. Now today we're going to be talking about some pricing issues. All figures and prices in this presentation are fictitious and for learning purposes only. Any and all discussion on specific pricing or attempts to fix pricing are prohibited and illegal per the FTC. We don't condone any attempts to do price fixing. Any attempts at price fixing is a big no-no. What we're here to talk about is the way to arrive at the right price for your company, whatever that price is and for whatever your company does. So let's talk about what we're going to talk about today. What's included in the selling price, labor costs, overhead costs, what goes into a billable hour, calculating a break-even price, industry average profits, what others are making, calculating your profit versus using markup versus margin, selling price, and how to sell your price, and then we'll have some time at the end for any questions. So today we're going to be talking about XYZ Service Company, and you can see a little breakdown of XYZ Service Company's staffing there. We've got 3 people working in the office, and we've got 5 technicians out working in the field. And you can see the salaries that each of those folks is drawing in. I want everybody to do me a favor right now, and just looking at that list and knowing nothing else than that, write down on a piece of paper what you think this company's billable hour rate should be. That is, what rate are they charging to their customers? I want to get everybody's initial thoughts on that, and actually, if you don't mind, go ahead and type that into the question box so that I can have that and refer back to that later. Just whatever that number might be, think about it, type it in. So I've got a few answers here. I'm not going to share those yet. I'll let this all play out. So what is the right price for your services? Unfortunately, all too often out there, there's the approach of just throwing the dart at the dartboard, seeing what the magic 8 ball has to say. Really, unfortunately, some folks call up their competitors anonymously and base their pricing on what their competitors are charging. That's horrible. Or that last set of graphics there, whatever they think the market will bear. All of those are terrible techniques, just not the way to do it. Our point today is to show you the right way to do it. The right price for your services is a dollar amount that covers all your costs of providing those services plus a profit of whatever percentage you choose to make. So let's talk about that question of costs. What are our costs? If we're going to be able to charge a price that covers all those costs, we have to figure out what those costs are. So labor costs plus overhead costs equal our break-even point. And for the sake of this discussion, we're not going to worry about material pricing. You get those material prices direct from your supplier, and that's kind of a fixed thing that you know from the start. Let's worry about labor costs and overhead. Labor is the wages you're paying to your employees, the payroll taxes and benefits that they get, and then your overhead costs are the costs to support operating your company. Let's take a closer look at those 2 items. So here's another question for the audience. And as you're doing this presentation out in the field, this is a good time again to just throw this question out to the audience and get some answers from the folks out there. For this XYZ service company, we said that the field employees are getting paid $50,000 each. But that's just their wages. What's the total labor cost for that employee to be employed by this company? If we start getting into the numbers, we have to be able to figure out our total compensation costs. There's a lot of little pieces that go into this. It's not just the wages, it's also the taxes, and there's a bunch of different ones, of course. There's Social Security tax, Medicare, federal unemployment, state unemployment, workman's comp. All those have to be calculated. So we'll go through our list of different costs for this field employee, all the different taxes. When we get down to the benefits that the employees get in this company, the field technicians get uniforms. That uniform service runs $25 a week. Health insurance, about $500 a month per employee. Hopefully they won't see major increases in that, but they probably will. Retirement contribution. This company has a retirement plan that contributes 2.5% of the employee's salary to a retirement, a 401k. So after you go through all of these numbers, what do we come up with? In this example, an employee making $50,000 a year is actually costing the company $64,501 a year. So it's a little bit of a premium on top of what the wages are on their own. And of course, these tax rates are just an example. Tax rates can be different in every state. They can change quite often. Make sure that you check with your accountant to make sure that the tax rates for your particular company in your particular area at this particular time are accurate. So that stuff's always moving. So XYZ Service Company, we said they have 5 technicians earning 50 grand each. Those benefits and taxes that we just calculated, 14 grand, 14,501 for a total of 64,501 times 5. So this company, the technicians are earning the cost for the technicians is $322,000 a year. Now, if you imagine a company where a real-world company where your technicians are each earning something different, that's a lot of math to calculate out all of those different technicians' total compensation packages. And if you're talking about more than 5 technicians, if you're getting into 10, 20, 30 people, that's quite a chore to figure all this out by hand. But we're not done there, because we've got to think about the office staff as well. So let me ask the audience, for the business owner of XYZ Service Company, how much should this business owner make a year? What do you think is a good, fair compensation number for the business owner? Go ahead and type that into the question box there. I want to hear what you folks have to say. So we got 1 vote for 100,000, 90, 40,000, whatever the owner believes he or she should earn. We have a few more 100,000s. For the sake of this example, I'm going to agree with the feedback I was getting from folks. For this company, we're going to say that the business owner is shooting for a salary of $100,000. Some folks just don't value themselves at that dollar amount, but really for the amount of risk that a business owner puts on the line to be an owner in this industry, and the amount of work that it takes to run a professional company, they've got to be thinking at least a number that's in the 6 digits, I would think. So what are the total labor costs for that business owner? Doing the same set of math that we did a few moments ago, throw in the Social Security taxes, all the other information. I left out uniforms for this business owner, figuring that he had a few hanging in the closet anyway. So we get to a total compensation cost for this business owner of $118,276. But there's other office staff as well. So we have to do that same set of math for the bookkeeper or office manager, for the receptionist slash dispatcher as well. So when we do the work and figure out all those costs for the other office staff, XYZ Service Company has $239,000 a year in office staff costs. So now we've figured out part 1 and 2, field labor costs, office labor costs. Add those two together and we have our total labor costs for this company. And it's coming in at $561,676. But if we're going to charge customers for that, we need to know those costs per billable hour. So here's another question for the audience. What is considered billable time? Answer that we have here. Billable time is time that can be directly charged to customers. That is when a technician is installing a water heater, performing a service call, hanging ducts in the ceiling. Non-billable time is time that can't be directly charged to a customer. So things like holidays, vacations, sick leave, driving time between jobs, time when they're in training sessions. Can't really bill that directly to a customer, although the customer does have to pay for it. So we need to figure out how we're going to do that. XYZ company is a service and repair company, so we're going to base our percentages on that kind of mindset. So when we're looking at the billable hours that a field tech will have, we have to start by taking off the top the time that they're not going to be at the company at all. So when we're talking about vacation time, in this company the techs get 10 days. 10 times an 8-hour day, that's 80 hours off the top. Holidays, 8 days a year, federal holidays that this company will give to their techs, so that's another 64 hours. Sick leave and training days add another 48 hours. So all in all, right off the top, we're removing 192 hours of potential productive time from the technicians. And of our 2080, that's a little over 9% of their time gone from the start. So that leaves us, for this company, with 1888 remaining. Now it's a time when someone who's working on this really needs to think through what a normal day for their technicians in the field looks like. When they're thinking about the work week, when the technician is going from job to job, how are they spending their time? So for this particular company, the business owner thought, okay, my techs are usually driving between jobs about 10 hours a week. There's a little bit of callback work that has to be done, and it averages out to maybe 15 minutes a week that we have to spend on that. Warranty work is another hour. There's a mandatory 1-hour meeting in the office each week for the technicians. And then there's some other stuff that he came up with, and it worked out to about 2 hours a week. So when you add all those things up, in this company's case, that's another 741 hours for each technician that they're not going to be able to be in a customer's home doing work that they can charge the customer for. And that represents another 35% of that technician's 2080 hours. So when you do all the math and bring it down to the bottom line, each technician in this company has 1,147 hours that is considered billable time that they should be doing work in a customer's home. And that's about 55% of their 2080 hours. And I'm going to bring your attention to this little red square on the right side. Of the hours that are remaining after we take out the vacation, holiday, sick, and training, if we say that this 1888 is 100% of the remaining billable time, then when you take out all this drive time, callbacks, warranty, meetings, and other information, that accounts for about 39% of that 1888. Those numbers come into play later when we're looking at the software. So just to match things up with this PowerPoint and that software, I'll throw out those numbers so you can see those. Okay. So our field technicians at XYZ Service Company, we determined that they have 1,147 hours, billable hours available to them each year. There's 5 technicians, so that's 5,735 hours total that this company can have a technician in a customer's home. Each one of those techs is costing the company 64 grand and change a year. Add all that up, and that's 322,505, and a little over 55% of that time is billable. These office staff, we determined, are clocking in at 239,000 in additional labor costs. What is XYZ Company's labor cost per billable hour? So in this company's case, the billable field employee time that is costing us $322,505 a year, just the billable time is 55% of that, and we divide that 322 times 55%, divide that by the number of billable hours that we have available, which is the 5735, and that gives us the answer of 3101. That is the billable hour charge needed to recover the cost for the billable time that the field employees are out there working in customers' homes. And of course, that's not all the time. There's also the non-billable time when they're driving from job to job or doing those other things that are non-productive, which represents the other 44% of their day. Do the same calculation there. That's another $25 that we need to get every hour to recover those costs. And don't forget about the office staff. The office staff are costing $239 a year. Divide that by the number of billable hours, and that's another $41.70 that we need to recover per billable hour to pay those costs. And I'm going to add a couple of these numbers together. I'm going to add the 25 and 41 together because I want to show the actual billable time for our field employees at 3101, and then everything else, the non-billable field time and the office staff time, where we're not recovering any dollars from doing work in the customer's home, and that's $66.93. Our total labor cost per billable hour for this company clocks in at $97.94. Okay, that's a lot of numbers. That's a lot of number crunching. That's a lot of poking at a calculator and having to remember what steps to take next. The point of this seminar and the point of the PHCC Educational Foundation's Overhead and Profit Calculator is to make that step easier. And everything we just talked about in all of those labor costs are covered just in the Step 1 worksheet of our software program. So I'm going to jump out of PowerPoint and into our Overhead and Profit Calculator software. So looking at this first worksheet, this Step 1 Employee Info Sheet, we've got a box here where we would put in all of our tax rates after we've checked those with the accountant. The software gives you an opportunity to enter in different departments. So if you've got work going on in service and repair plumbing, service and repair HVAC, new construction, you can have different departments for each of those and be able to split out your cost within the software so that you can get a clearer picture of what that department is costing you. For the sake of simplicity for this presentation, they just have one department, the service and repair plumbing. Now let's actually look at some of the information here. The business owner is earning 100 grand a year, and the hours that we talked about them taking off, the vacation time, the holiday, sick, and training, all those hours are entered here for each employee. We can also see the technicians here, each with their $50,000 a year salaries. We had talked about the benefits that the employees get. That's covered down in this section of the worksheet. So each of the folks in this company are getting $500 a month worth of healthcare costs covered by the company. So that expense goes on this line. The uniforms for the techs are on this line as a weekly cost. The percent of their salary that they're getting as a retirement benefit is covered on this line, and the worksheet reports back to you what the total cost of those benefits are for each person per year. And those get added in, and we can see the total cost for each employee reflected here. And if we want to look back at the PowerPoint for a moment, that business owner that we said was costing $118,276 matches up here, $118,276. The technicians that are costing $64,501 matches up here, $64,501. This Excel spreadsheet has all of its numbers tied back to the PowerPoint, and for anyone who is going to be doing a presentation for their chapter on this, I'll give you this the PowerPoint and this Excel sheet so that you have all the numbers in both that match up, make it real easy for you. Now, as far as our billable hour time, that's calculated by the spreadsheet in this section. The spreadsheet will allow you to enter in time spent in the office and in the field for each person. And if you've got someone who is like a business owner who is still carrying a toolbox, you can have a situation where you can enter in time for both. In this example company, we're just leaving it straight that the office folks are office folks and the field techs are field techs. So it's up to you again to enter in how much of their time you think each person spends in each department. In this example, we're saying that the business owner spends about half the time on pure general administration issues for the company, and the other half of his time on items that are directly related to the service and repair plumbing part, versus like our dispatcher, who may only spend 25% of the time doing general receptionist duties versus 75% of the time doing actual dispatch related to plumbing. Now for our technicians, we've got our 5 techs out in the field. We have to come up with a number that is going to that we're going to put in for their time that is in the field, non-billable to customers versus billable to customers, and that's how this is broken out. So for each of our 5 techs, I've entered in 39.25 non-productive and 60.75 productive. How did I come up with those numbers? Well, if we go back to the spreadsheet, the PowerPoint here, where we talked about the field hours for the technicians, right here is where that 39.25% comes from. When we take out of the 2080 all the vacation, holiday, sick, and training, and have that 1888 remaining, and then pull out our non-productive line items for dry time, callbacks, warranty, etc. That's where we get to this 39.25 that we see right here. So when you're talking to folks about how to use the spreadsheet, remember when you're putting in your field non-billable time, this number here has already taken into account all the time off for vacation, holiday, sick, and training up here. So you're starting from a number that has already taken all those things off the top. So our techs are non-billable, roughly 40%, billable 40%, and this step 1 worksheet has taken us through everything that we did in the PowerPoint up to where we broke away from it. So now let's head back because we need to talk about our step 2, which is overhead costs. So part 2, overhead costs. These are costs to support operating the company. Overhead consists of costs that you can assign to a specific job. They're the costs that would remain to maintain the business even if you weren't doing any work. So we need some examples. What are some typical overhead costs? Advertising, rent for the building. All these different things are overhead costs that that a business owner needs to be considering when they're developing their pricing. All right, for XYZ Service Company, these are the overhead costs for the company. Now, do we have any volunteers? Who wants to break out a calculator and actually sit down and crunch through all of that to come up with a total? Yeah, I don't want to do it. You don't want to do it. Good news is we don't have to because, hey, that's what we have the software for. Excel is all about crunching numbers, so let it do its thing. We'll go back to the software, go to step 2, overhead, and here are all of those different overhead items that we just saw up on the screen. And in the blue cells here, it's asking the user to type in what their annual costs for these items are. And so you would put in your annual cost, say for direct marketing here at $4,500. The spreadsheet will tell you on a monthly basis that's $375. For all the overhead costs that are entered into the spreadsheet, that is 2.4%. And since I have enough information to figure out what your potential sales revenue should be, I can also tell you what percentage of your sales revenue that's going to be. And at the bottom of each of the subsections, it will tally up the numbers. That really comes in handy, for example, if a company is trying to target their, say, marketing costs to a fixed percentage of their company overhead. In this case, 7% is what they are shooting for marketing. They can figure that out pretty easily. Now, again, we're not really doing it so much for this presentation, but the software does have the ability to split those costs for overhead across different departments. So if you had 3 or 4 different departments and you had some of these charges that only applied to a specific one, or you wanted to split some of those costs across the different departments, you would simply do what you can see here, just put in a percentage of what that department's share of that cost should be. And it will automatically take that out of the general company support column here. So we've got all sorts of line items here for advertising, your building and utility expenses, consultant fees, employee training expenses is its own category. That should be a category that more folks are budgeting for but don't. All your general office operations, including those contributions to the foundation and your PHCC dues. In this company, as an example, as a percentage of the sales revenue, their PHCC dues are only 1/10% of their sales revenue. Dues aren't expensive, especially if your customers are paying for them. At the bottom of this screen, it will tally up all the numbers, give you an annual overhead cost, monthly overhead cost, and percentage of the sales revenue again that your total overhead is. So instead of crunching all those numbers by hand on a calculator, we let Excel do the work, and everything's set up to give you a good, accurate number. Let's bounce back to our PowerPoint. So when we add up all those overhead costs, we determined that XYZ Service Company has a little under 16 grand in monthly overhead costs, or close to 189,000 a year in overhead costs. But again, we need to figure that out on a billable hour basis so that we can charge the customer for that. we'll go back and remember that we've got 5,735 billable hours. We divide our overhead costs by that number, and we come up with $32.94 per billable hour that needs to be charged to the customer in order to recover our overhead costs. So great. We've got our labor costs. We've got our overhead costs. That's our total cost of doing business here. $130.88 per billable hour. But we're not done. Of course we're not done. Those are just the dollars to break even. We haven't made any profit yet, and what's the point of doing all this work if we're not going to make any profit? So let's figure that out, because we need to add that to those other costs to get to our final selling price. So does anyone here know, and I'll go ahead and again ask you to type it into the question box, what is the average PHC industry net profit? Go ahead and type that in. All right, the feedback we're getting here is 2%, 10%, 3 to 5%, 15, 2, 5 to 7, 3. There's a few folks who have probably sat in on one of these seminars before. If you look at the overall picture, it's about 3%. And the numbers were actually 2.9% back in 2007, right before things went all sorts of crazy. So that number might be different now than it was back when things were going gangbusters and everything was good in the world, and it was only 2.9%. And yeah, there's some good feedback here. Someone wouldn't get out of bed for 3%, and I think that's a pretty fair statement. Now, if you're a service and repair company, you're going to have a higher profit percentage on a lower volume of sales. When you're talking construction, usually you have a higher volume of sales and a lower profit percentage. But whatever you're doing, don't aim to be average. Be above average. Let's say for this example, we want to make 10%. So here's another good opportunity to do a little eye-opener for your audience. Ask them to please tell you, what is your selling price if you want to make 10% on a job with $100 in fixed costs? And I want you all to do the math for me right now and type into the question box, what is your selling price if you want to make 10% on a job that costs $100? Okay. So we're basically getting two different answers here, and that plays perfectly into the discussion that we're going to have right now about markup versus margin. When we're talking about markup, this is the easy way to figure out your selling price, and unfortunately it's also the wrong way. This is the technique that a lot of contractors use, and it comes back and bites them, but unfortunately they may never even realize what they're giving up when they use this method. So if we're talking about taking 10% of cost, $10, and adding that to our cost of $100, we end up with a marked up selling price for the job of $110. But did we make 10%? And the answer actually is no, we didn't. Because if you do the math and figure a 10% profit on a $110 selling price should be $11. So 110 is $1 short. We're missing a buck. Where did it go? That's where the margin method comes into play. The formula for calculating a selling price based on margin is your selling price is equal to your fixed costs divided by 1 minus the profit percentage divided by 100%. That's a mouthful of a formula. Let's make it a little easier by actually putting numbers to it. Your selling price is equal to $100 in this case, divided by 1 minus the 10% that we want to make divided by 100%. 10% divided by 100%, that's 0.1. 1 minus 0.1 gives us that 0.9. And when we divide the $100 in cost that we have by that 0.9, we get our selling price, which is $111.11. And if you do your fact check on that and look at what's a 10% profit on $111 selling price, there's your $11. It's confirmed. That's where the extra dollar went. So if you're looking at a comparison of those two, the markup method, when you add 10% to your costs, you're actually only making a net profit of 9.1% versus the margin method where you actually make the 10% that you intended to. In this case, for a $100 job, the difference in our selling prices is about $1. Okay, so what? It's $1. Well, what's the difference in dollars between the markup and margin methods on $1 million in sales revenue at 10%? That's when things start to get serious, because we see that using the markup method, $1 million plus 10%, that's 1.1 million that we're bringing in revenue, versus the margin method where we would bring in $1,111,111. And the difference there is that 11 grand plus in lost profits. And here's a point to drive home with your audiences. That $11,000 in lost profit is net profit. To be able to recover that $11,000, the only way you can recover it is by doing additional work. So how much work do you have to do to recover $11,000 in lost profit when you're trying to earn that 10%? For this business, in this example, the company would actually have to sell an additional $111,000 of work to make up that lost profit, just because somebody did the math wrong in calculating their profit percentage. So do you think it's easy or hard for a company that is doing $1 million worth of work to do another $111 million worth of work? It's tough. So that's a point to drive home with your audiences, that you really want to take the time to calculate your profit using the proper method. Use the margin method. Do not use the markup method. Bad, bad, bad. So let's take this chain of numbers all the way through to the end. We figured out our labor costs at $97.95. We figured out our overhead costs at $32.94. That gives us a break-even price per billable hour of $130.89. We just figured out our profit using the margin method. If we go through the math for this company, that comes out to $14.54 per hour per billable hour that needs to be added. And here's the magic number. For this company, they need to be charging their customers $145.43 every billable hour. Every hour they've got a technician in a customer's home, that's what they need to be charging. Now, what does that look like in our software? Well, that's covered in step 3. Step 1, we did all the labor costs. Step 2, we did all the overhead costs. Step 3 is our pricing. We had talked about the billable employee field time coming in at $31 an hour. The field employees non-billable time and the office employees time coming in at $66.93 an hour. That overhead coming in at $32.94 an hour. The break-even at $130.89 an hour. We asked the user here in the blue cells to type in what net profit percentage they're looking for, and here the software tells them 145.43, 145.43. Everything matches up. But it was a lot easier to get to that point using the Excel sheets than it was doing everything with a calculator by hand. Now again, this sheet will give you all the different departments that that if the end user has taken the time to split out their costs into different departments, right here on this sheet, they'll be able to determine a different billable hour charge for each of their different departments. Where that can come in handy is if, for example, they have one department that is a little riskier than another department and deserves a little extra profit because of that risk. They can independently set the price for that one department higher and have the spreadsheet actually come up with a selling price for that one department that's different than the overall company's rate. We do encourage the users, though, if they're going to have go through the effort of determining their different departments' rates, that they choose to either use the rates for each department or stick with using one rate for the overall company. If they use the overall company rate for some things and the individual department rates for other things, you run a risk of not quite recovering all your costs just the way things are calculated. So use one or the other, and it says that up here in the instructions. And some little things that we threw in on this worksheet so that you'd be able to get a better visual of the breakdown of your pricing components. We've got a graph here that you can change for each of your different departments that will tell you what percentage of that department's selling price is the different elements that we talked about: billable, non-billable, company overhead, profit. If you've got different departments in here, you can have the spreadsheet do comparisons between the two departments so you can see the differences in numbers. I'm going to come back to the spreadsheet, but I do want to finish up a little bit on the PowerPoint here. So what I've shown you so far in the software is just step 1, step 2, and part of step 3. But let's finish up by talking a little bit more about some of the elements of your selling price. And I want to throw out this warning here about trying to recover your costs through material markups. We're living in an age where the internet is a great helper and a great burden in some cases, and we're at a point where savvy customers, if you throw material pricing at them, they might be pulling out their smartphone and looking up those prices on the internet to compare what you're charging them with what they could buy it for, even if they're not smart enough to know that the quality that they would get from, say, a big box retailer isn't the same quality of part that you're putting in that you got from your wholesaler. It doesn't really matter to them. They don't know that you could try to go through that fight with the customer and explain everything, and you're welcome to do that, but in the end, it's probably just going to be easier to not try to recover any of your costs through markups on your material pricing. It's much, much harder for a customer to do a comparison between your labor rates and a competitor's labor rates, because those sorts of things aren't typically posted on a website versus materials. So keep that in mind. If you want to charge get a little bit of profit on a markup on your materials, you're welcome to do that. Just don't rely on that to recover your cost. That can put you in a corner and force your technicians into a discussion that they're not really wanting to have. So, $145.43 per billable hour. That's the price that XYZ service company must charge for every hour that their techs are in their homes, and that amount will recover all their costs and make them the net profit percentage that they want. The owner of XYZ service company has a choice. He can either sell his company services at that price or slowly go out of business, losing money on every single job they take if they're not charging that much. So at this point, it's a good time to turn the question out to the audience. What do you all think about this price? Now, depending on how savvy your audience is, and the folks on this call are pretty savvy, so if you're on this call, I imagine you already know that that's a pretty fair price. for this company. And some folks even think it's low, I'm seeing. For the people in the audience who don't know their cost and are charging something way below this, this kind of number per billable hour is going to come as a sticker shock for them. And they might be thinking to themselves, well, good for them, but I could never charge a labor rate of $145 to my customers. They would never stand for that. And here's where you need to make the point that if that rate reflects the true cost of doing business for that company, and the business owner makes the decision to charge less than that rate, then that business owner is deciding to slowly put their own company out of business, to lay off their employees because they won't have the money to pay them. They're choosing to default on loans that they've made personal guarantees on, and they're deciding to steal money from their vendors that they owe money to. If you're not charging enough for your services to recover your costs and make a profit, then you're basically playing a cash flow game. And the cash flow game can only keep a business in business for so long. Eventually it's going to end, and it's going to end badly. So selling your proper labor rate to your customers is all about how you package it. And when I put up that last slide, I had a couple folks asking about flat rate. And that's exactly. One way to package your rate to the customer is a flat rate pricing system. That's a whole other seminar. There's lots of good things to talk about there, but there's a lot to talk about there. Don't have time to get into that. If you want to read some more about flat rate and its advantages, you can go to the Foundation's Contractor Resource Center and look up some articles that we have online there about that. The big thing about doing this exercise is once you've gone through the work and properly calculated your selling price, you're going to have confidence in that price. You're going to know that charging less than that price means losing money. And you're not going to be as willing to let anyone fast talk you into a lower price. If you've got somebody who's trying to wheel and deal you into a rate that's less than what you know it costs you to do business, then you're going to be having that argument, that discussion from a position of power, because you know that you can't go lower than this without going into the hole. Confidence is one of the main things that we're teaching with this session. Have confidence in your number and go ahead and charge that. How many of you have actually calculated your real costs and based your price on reality? Are there any questions about these concepts? Anything that anybody wants to throw out? So more folks are asking about markup on materials. What I'm saying is that you shouldn't rely on the markup on materials to recover your cost of doing business. You should cover all of your costs of doing business in your labor rate. If you want to mark up on your material pricing, think of that as icing on the cake, the hot fudge on your sundae, a little something extra. But you shouldn't rely on your material pricing to be paying the bills, because at some point you're going to be confronted with a customer who says, "Hey, I can get that same thing that you're putting in at half the price that you're charging me. Get the heck out of my house. You're ripping me off." We talked about what's included in a selling price. We talked about labor costs and what goes into that, the benefits and taxes. We talked about overhead costs, what constitutes a billable hour, how to combine those numbers to come up with a break-even price, what the average industry net profit is, about 3%, and why you should be aiming for more than that. We talked about calculating your profit versus using the markup method versus the margin method, and we talked about your selling price and then how to sell your price once you come up with it. The rest of the overhead and profit calculator software, at this point, I'm going to jump back into the Excel sheets and just give you a real quick run through of everything else that's in there. And so Before I jump back into that, I'm going to take another peek at the questions here. What is the cost of the software? The cost for the software for PHCC members is $199. For non-members, it is $249. Let's see. Another question was, did you include owner salary in overhead? We did not include that in overhead. We included that in the labor cost. If you recall, back in step 1, the owner's salary was not in overhead; it was in labor costs. That gets included in this line right here, the non-billable and office employee time costs. That's where the owner's salary and the other office staff salaries go. Vehicle costs. Vehicle costs are covered in the overhead worksheet. So you've got your choice here, and we actually have a little pop-up help to talk about it. If you're depreciating your vehicle payments, you would handle things one way, or if you're not depreciating, you would handle it a different way. The spreadsheet allows you to handle that whichever way you go. But all of those vehicle and equipment costs, either purchases or leases, are covered in the overhead worksheet right here. Okay. So that's all the questions there. And again, I'm just going to run through quickly some of the other things that are available in the software. Some extra tools that are available here. We've included a quick job pricing worksheet. This allows a user to enter in for a small job how much the materials that they're using cost, if they have any other job costs, how many billable hours are going into this job, what net profit percentage they want to make, and the worksheet will tell them what they need to sell that job for. It's a very quick and easy way to do an estimate. Someone in the field with a laptop can figure out how to come up with a price if they need a quote immediately. A big part of the Foundation's discussions about profitability tend to revolve around productivity. The single easiest way to increase profitability is to increase productivity. So we included in the worksheet here a little calculator to show what impact increased productivity has on profitability. In using the same numbers from this little quick job worksheet here, we asked the software to tell us, if I was able to make my field employees 5% more productive, what impact would that have? And you can see that the worksheet tells you, well, if you are able to get 5% more every day out of your technicians, well, that would drop your costs per billable hour from 130 an hour to 124. And instead of having labor cost of $3,200, your labor costs are now $3,100. And if you wanted to, you could sell this job to the customer for $4,795 instead of $4,969 up here when you were 5% less productive. But it also tells you that if you instead decide to pocket that difference, instead of earning 10% on this job, you're actually now boosting your net profit percentage to 15%, which is an increase of 51% over that 10% that you originally were charging. So to sum it up in one sentence, this worksheet is showing you that if you can make your field technicians 5% more productive, you boost your expected profit rate by 51%. And all the numbers are dynamic. If you're able, it's not realistic, but if you could get 20% more productivity out of your technicians every day, you can boost your expected profit by 165%. It's just a quick, neat little tool to use to show that relationship between productivity and profitability. Didn't stop there. Step 4. Step 4 is filled with different reports that the user can see. You know, you've taken all the time to enter in all this pricing information. We thought of all the different ways that we could crunch those numbers and report them back to the end user so that they could use them to make better decisions. And this is what we came up with in this step 4. You're actually able to compare employee versus employee on things like their billable hours, their costs per paid hour. You're able to see for each technician how much revenue that technician is bringing in per year, month, week, day, hour, minute. You're able to compare department to department the wages, the taxes, the benefits, total compensation costs, the billable hours that that department is generating, so on and so on, and all of that is graphed out here in these charts. The spreadsheet will tell you projected sales revenue for each of your departments. It will tell you what the wage costs for each of your departments are, your employee costs for each department, your overhead costs for each department, and then what your net profits are for each department, figured out 2 or 3 different ways. It will report to you what your company costs are for your employees, your overhead, the revenue that you're generating, and your net profit, again, per employee, per year, month, week, day, hour, or just for the overall company, year, month, week, day, hour. It will tell you for each department what percentage of your hours are billable. For the overall company, the breakdown of billable field hours, office hours, non-billable hours, leave hours, etc. And the nice thing about these spreadsheets is we set them up so that they would print in a nice clean manner. So if you wanted to, you could print all of these up, tack them on the wall of your office, and or use them at a company meeting and be able to talk from these numbers and kind of have an open format with your employees showing them the numbers for the company. And that's the case with all of the worksheets. They're all set up in a manner that they should be able to print nice and pretty charts for you. Step 5 is what I like to call a reality check. You know, all the numbers that we've asked you to put in are based on your projections. And if you had the actual numbers, we wanted, you know, the actual numbers, but the spreadsheet has taken everything that you've entered in and has created a projection based on those numbers. What we want you to put into the blue cells in this step 5 analysis worksheet is what your actual sales are, so that you can have the spreadsheet compare what your actual is versus what it thinks you should be making based on what you told it. So after a user puts in their actual numbers here, the spreadsheet will tell them what they're actually making versus what the spreadsheet thought they should be making based on the numbers they put in. If the user sees a big difference here in the numbers, they know that either something isn't happening according to plan or they made a mistake in their data entry and they need to go back and check that. Finally, the last step here, step 6, is a spreadsheet that some folks asked us to add in for this release of the software. It's basically a cash flow planning tool. You can see for the chart here, it's got the different months, January, February, March, April, May, going over to the right. And it's got a whole bunch of numbers filled in for both your sales revenue and your expenses based on the numbers that you already typed in earlier in this process. All it's asking from you for this for these calculations is what percentage do you think of your sales revenue and your expenses are going to fall in each month. So by default, we have it set up where it's a pretty even split for the 12 months, 8.3% for each month. But if you know that you're an HVAC company and you do a lot more work on the shoulder months where you're having swings in temperature and people are freaking out because they find out that their systems aren't working, you're going to pile in an extra percentage in those months. If you know that you're going to be doing more advertising in the months before that to get your name in front of the customers before they have a problem, then you would load up those months' percentages, and it will crunch all the numbers out, and it will give you a nice chart here at the bottom where it will tell you month by month what you expect the company cash flow to look like. So you can see if you've got a month where you're spending heavily but not getting a lot of revenue in, where you're going to have a big dip, and just how far that dip is going to be before you start bringing in the revenue to bring it back. The user has a choice here. They can enter in numbers just in the overall company worksheet, or if they're very detail oriented, they have the option of putting in those numbers for each and every one of the 10 different departments all the way down. That's a lot of numbers. So for 99% of the public, just using this overall company budget worksheet is going to work fine for them. But they've got the option of going more detailed if they want to. And I hope you've seen that theme throughout all these worksheets. It's pretty simple to use, but if you want to go more detailed, you can. And that's it. That's the Overhead and Profit Calculator software, and that's the presentation. And thank all of you for attending this session. If you have any more questions, go ahead and toss them out now, and I'll try to field them. If you have any more questions after this session, go ahead and email me. And if there aren't any other questions, let me see. I only saw one vehicle payment line. Shouldn't there be one for each tech? You could approach it that way, doing a different vehicle for each technician. The way we handled it in this software was just doing one total, combining all of those vehicle payments onto a single line item in the software. And again, that's right here, vehicle payments. We just added it all up and had it on a single line for this company. Okay. So again, just want to say thank you to everybody, and give me a holler if you want to know any more. Thanks again.